You can spend decades building a solid nest egg, but then suddenly one day realize the hardest part isn't saving. It's taking money out without triggering a tax avalanche. That's exactly what today's story is about, and it comes from a real call with someone who thought she had things figured out until she looked a little deeper.
Welcome to Retirement Red Flags, where we unpack real stories from real retirees who've saved well, but still wonder what they might be missing.
Today we're talking about someone we'll call Barb. Smart, resourceful, and a little skeptical. Barb isn't new to managing money. She's 61, has over $1.5 million saved, mostly in a 401k, and even owns rental properties. But what stood out? She wasn't just hoping things would work out. She was actively asking, what's the smartest way to spend this money in retirement?
And one of her biggest concerns, maybe one you've had too, was taxes. Not today's taxes, but the taxes lurking at age 75 when required minimum distributions, or RMDs, kick in. Because most of her savings were in pre-tax accounts, she said, I just don't want to be surprised.
Barb had a sense of humor about it too. When asked about legacy planning, she said, I'm planning to spend it all. If there's anything left, well, they'll get it.
But don't let that fool you. Barb was intentional. She'd already been thinking about her glide path, gradually shifting her 90-10 allocation to something more conservative. And she was open to learning about strategies, not products, that could help her get ahead of taxes while she still had time.
And that's when she came across something a lot of retirees haven't heard of, a tax-refundable bond.
It's a strategy some retirees use to ease the tax sting of RMDs. It's not magic, and it's not for everyone, but it works like this. If you're forced to take out $50,000 at 75, and $20,000 of that came from this bond, you'd pay taxes on all $50,000. But the taxes paid on the $20,000 from the bond get refunded.
In other words, it can make a chunk of your RMDs feel like you're only being taxed on $30,000 instead of $50,000. That's a big difference when you're trying to keep your income and tax bracket under control.
And that's the moment Barb realized the biggest tax hit wasn't from spending, it was from saving in the wrong buckets. If she didn't act now, most of her retirement income would be taxed later, possibly all at once.
But here's the shift. Instead of feeling stuck, Barb started to feel equipped. She had a plan. Start adjusting her portfolio this year. Allocate a portion to the bond, then slowly do Roth conversions, but only up to the edge of her 12% tax bracket. No guesswork, just strategy.
And even though she wasn't planning to leave an inheritance, she finally had clarity around why she was doing what she was doing. It wasn't about a fancy product. It was about controlling her income and keeping the IRS from taking the first bite.
If you've ever looked at your statements and wondered, how do I actually turn this into tax-smart income? You're not alone. Barb's story is a great reminder that clarity doesn't come from having all the answers. It comes from knowing the right questions to ask.
Even if you're not quite ready, it helps to know what red flags to look out for. That's why we put together the free retirement checklist, just like the one Barb used.
Retirement's not about hitting a number. It's about knowing what comes next. And that's why we keep telling these stories. And if you want more stories like Barb's, or you're ready to take that first step toward clarity, visit us anytime at retirementredflags.com.
Until next time, keep asking the smart questions and keep an eye out for those red flags.